This episode is sponsored by Postman. Postman is the world's leading API collaboration platform, and they just launched Postman AI Agent Builder, the quickest way to build AI agents. Start building at postman.com/podcast/cloudcast.
Cloudcast Media presents from the massive studios in Raleigh, North Carolina. This is the Cloudcast with Aaron Delp and Brian Gracely, bringing you the best of cloud computing from around the world.
Good morning, good evening, wherever you are. Welcome back to the Cloudcast. We are coming to you live from the massive Cloudcast studios here in Raleigh, North Carolina. Hope everybody is doing well. Hope everybody who is watching the NCAA March Madness bracket is not busted by this point. I think by the time anybody is listening to this, most of the first round will be close to done. That's sort of where we see all of our biggest upsets, our big Cinderellas come through, the thing that really makes us love that tournament. But anyways, hope everybody's doing well. Spring is upon us. I just celebrated another year around the sun. So a little bit thinking about some things. But what I want to dive into in today's weekend perspective is having nothing to do with basketball, having nothing to do with birthdays, having to do with what feels like a little bit with things like The Wiz getting acquired by Google and a few others here recently, at least being rumored to be acquired. It feels like maybe tech acquisitions are going to make a little bit more of a comeback. Part of that is going to be the new administration that's in place is considered to be a little more business friendly, a little more, open to allowing acquisitions versus making them get hung up in sort of legal ramifications and justifications and all those sort of things. And although most of the acquisitions that happen today are somewhat global in scope, and so they've got to go through EU regulations and scrutiny and China regulations and scrutiny. There is some perspective from sort of the VC class in the tech world that acquisitions might be more on the table. And so the reason I bring that up is, I know there's a lot of folks that listen who are working in startups or thinking about startups. There are people who work in larger companies. And acquisitions have in many cases, a material impact on the competitive nature of the markets that we play in, that we do work in, that we are buying goods and services from, and so on and so forth. And I thought it would be interesting to sort of dive in and talk about acquisitions a little bit, not from a, who might acquire who. We can do that on a Cloud News of the Month type of show. But sort of like what happens when the acquisitions happen? Because there's a lot that goes on beyond just the initial press release where everybody says, how much money did they make? Did the founders make a lot of money? Did the people working there make a lot of money? Did the founder make a statement like, they are acquiring us for our culture, we don't expect anything to change, all those sort of tropes and things like that. The reason I bring this one up is, again, I think it's interesting to sort of explore what happens with these things for a couple of reasons. One, most acquisitions fail. They're just like VC investments, right? They oftentimes sound great on paper, but the execution of them is very difficult. It's difficult to bring two companies together, two leadership teams together, two technologies together, even if at the time they're both very successful, to make those things successful. So, the track record of acquisitions is not great, but it is oftentimes considered to be, a much faster way to, have certain capabilities in the marketplace as opposed to building, right? So that's the first thing to keep in mind is while everybody gets excited when acquisitions happen, most times their track record of success, at least big time success, is not great. I'd have to go look at the numbers, but I think they're in the sort of 10 to 15% sort of success rate. But companies do them quite a bit. For me personally, over my career, when I was at Cisco Systems, which was about a 10 or 12 year stint, we did 125 acquisitions. So Cisco was a company who, very much was focused on acquiring sort of what they always used to call adjacent markets. So I lived through a lot of those acquisitions, got to see what a blueprint for successful integration looked like, a blueprint for, in some cases, poor integration, saw what it looked like to have lots of different types of founders and leaders come in, what their personality did to it. So was involved with that quite a bit. I've worked at companies that have been acquired, worked at Red Hat when it was acquired by IBM. We have had hundreds of companies on this show that we've interviewed that have gone on to be acquired. So we've gotten to hear a lot of their backstory and so forth. So I feel like I've got a pretty good sense of what happens. I've seen the goods and the bads and kind of all the in-betweens. And I thought what I would do is kind of walk through some things to take a look at, and whether this is you are the acquirer, you are the acquiring company, you are watching it from afar. Maybe you use the technology of one of the companies that's being acquired, and you're concerned about will this be successful or not. So I thought I'd walk through a whole bunch of different things in terms of how to view acquisitions from the lens that's appropriate for you, and then you can kind of get some sense of like, how well is it going? What are the plans for this? How will things change from before, where they were two separate companies doing business entirely on their own, and those types of things. So let's go ahead and just sort of dig into a bunch of different aspects of this. And again, these aren't in any necessarily priority order, because they're just they come at it from a business perspective, a people perspective, technology perspective, change perspective, and so on and so forth. Okay. So I guess the first question to ask is, who is acquiring and who is being acquired, right? Why is this thing happening in the first place? Is it, what's unique about the two different companies? What's consistent between the two different companies? And so this is where you're really looking at the culture of the two companies. You're looking at the size of the companies. You're looking at their go-to-market approach. Those, even just those three characteristics can tell you a lot about how it's going to go, right? Oftentimes we see large company acquiring small company. Okay, that's pretty normal. So the first thing that ends up happening is the small company, has to figure out how do we survive in this big culture. But at the same time, the big company has to figure out, how do we take advantage of what this company does, but use our scale to our advantage. So for example, oftentimes what happens is big company acquires small company, and the small company has been doing relatively well. They've figured out product market fit. They figured out some early customers. They've figured out some things that they do unique in the marketplace, but oftentimes, they just don't have the capital to scale to become the big company. They don't have a large sales force. They don't have enough dollars to put into marketing, all those sorts of things. So, oftentimes one of the first things that you look at when can the bigger company's ability to go to market, their sales force, their marketing, their channels, their partnerships, can you fit into that, right? So that's sort of the first thing you're often looking at is how does the culture, the size of the companies, and their go-to-market approach, how much synergy is there between the two of them, or how much complete difference is there between the two of them? And complete difference between them doesn't always necessarily mean a bad thing. It just means you're going to have to adapt it in different ways, right? So, for example, if you were a software company that acquired a SaaS company, for example. So I'll give you an example. When Cisco first acquired WebEx. So for those of you who don't know what WebEx is, think of it as like Zoom. But fundamentally, Cisco was a hardware and software company, and it was the first time they acquired a SaaS company. And so just the mechanism of how does a company that has a sales force, a gigantic sales force, who could absolutely sell this new thing, but how do they go about, for example, getting paid when previously they would get paid when the product, when the product or software was sold, and now you've got this sort of recurring revenue stream. They're going to get paid out as revenue comes in on a month-to-month basis, right? Even little things like that, which would seem like little things like that, are huge in terms of like, can we leverage this huge asset that we have in terms of like a sales force, a route to market, and so on and so forth, with something that is completely different than what we do. All right, so that's one of the first things that you take a look at. Now, the flip side of that is that might not always be a terrible thing. This might be something in which, you go, well, we've never really been in the SaaS business. We're not only going to be able to learn a lot about how to, how to work in that market, but also, the future plans might be to acquire 10 more SaaS companies. And so this becomes the beginning of a much bigger strategy. So again, the difference between the acquirer and the acquiree sometimes should be concerning, but other times, if you think about them in the bigger picture of things, they are the beginning of what could be a much, much bigger strategy, right? Another example of that, Oracle, Oracle went from selling software to acquiring a whole bunch of SaaS companies. It was a huge part of sort of their application business for a while. There's lots of examples of things like that. Second thing is, why are they being acquired? right? Why is the acquiree company, why are they being acquired? Are they being asked to, are they, for the acquiring company, do they represent a completely new market, right? So maybe you are in, some aspect of the market. Let's say, for example, let's say we get out of the tech space and we said, hey, you are an automotive company, right? You're Ford or General Motors or Tesla or Honda or somebody, and you say our business is primarily, selling vehicles, whether it's to fleets for businesses or to individuals or whatever, but we really have no understanding of what the market for daily rentals is, for example, or something that is not an ownership class of the vehicle. We're looking to get into sort of this rental thing, and so that might be a completely new market for what you do. So new market is one reason why they might be getting acquired. We want to move into a space that we think in the future is going to be a huge market, and we need to have a presence there. The second one is an adjacent market, right? So this was always kind of the mantra of when I worked at Cisco, and I said we did 125 acquisitions. It was our primary business was in networking, but things like wireless networking was an adjacency. Security and firewalls was an adjacency. In some cases, when people started doing, for example, like video over the network or voice over the network, those were considered somewhat of an adjacency to what we were doing, expanding out the usage and capabilities of what we did. So that's another thing that people will do. And the third is oftentimes the technology, for example, that's being acquired, the companies being acquired, specialize in some sort of integration, something that you might not really ever see directly. You may not think about it all that much. It's not like you're ever going to have somebody knock on your door as a salesperson, but the integration is going to provide a huge capability. So, for example, Amazon or AWS acquired a company called Annapurna Labs, which ended up creating a chipset technology that is embedded in EC2 and allows them to integrate things like storage and networking and hypervisor and so on and so forth. It's really kind of took their EC2 compute capabilities and rapidly expanded them to be able to do all the flexible things that you see them doing with database and serverless and all sorts of stuff. So that's an example of a company that's sort of an integration, powerful technology, but kind of you're not necessarily going to see it after the fact. So that's the second thing to sort of take a look at is when this acquisition happens, what do we expect the focus to be for the acquiring company? And again, depending on what it is, you're going to see very, very different behaviors. The third piece of this, and this sort of goes the same as the last one, is this a sort of a front end acquisition? So something that you're going to continue to see out in front of you as something that's being sold. Is it a back end capability? So maybe you are acquiring a company for their ability to collect data for or maybe they harvest data from lots of different sources. They are an aggregator of information or something along those lines. That might be something that becomes part of a bigger service that's offered, but you're never really going to necessarily see what that company does anymore. Again, I mentioned if it's an integration, or the last piece that it could be is it could simply be, and we've seen this, especially when we start to have these new trends in the market, we're seeing this a lot in the AI space, is this primarily sort of an acquihire, right? Like the technology that we're getting from this company is interesting, but more importantly, we're getting a number of people that have domain expertise and can really accelerate things for us in this space, right? And we've seen this a lot in the AI space where, Microsoft or Google or Meta or anybody is acquiring a whole bunch of, domain-specific data scientists that are doing that. Their product the thing that they were working on might never see the light of day, but their skills will now be applied to a, much bigger set of problems, right? So, that's another one where you sort of have to go, okay, what are they planning to do with the product, right? And that'll give you some sense of like, what sort of outcomes can you probably expect 2, 3, 5 years from now? Okay. The next piece of this becomes, what are the benefits of the acquisition? Like, why would they want to do this? And I sort of pair this next with the sort of the next thing I had on my list was, did the acquirer try and build it themselves first, right? And this is something we see quite a bit. So, here's a scenario, and I've seen this at a whole bunch of different companies I've worked at, in which you have a core set of products, you're working with your customers in the marketplace, and they come back and they go, well, it's nice what you do, but it would be really cool if instead of having to deal with 3 different vendors or 3 different kind of integrations or whatever it was, it'd be nice if sort of all of that was owned by one company. And that way, we could push it in new directions, make it more automated, make it more integrated, make it less things that could fail, whatever those things might be. And so this is where you sort of get into where you kind of have to ask the question, did the acquirer first try and build this before they bought it? Right. And that build versus buy conversation is something that we see lots and lots in the marketplace. We see it a lot as vendors try and sell to customers, in which they go, well, yes, you could build this yourself. You could maybe use a whole bunch of open source components and do this yourself. But is that really the type of value that you want to create for your company? Right. You used to hear Werner Vogels, who was CTO, or I think still CTO at Amazon Web Services, say do you still want to focus on undifferentiated heavy lifting, right? And the reason I bring this up is, especially in an acquisition, this is kind of an important thing to understand because for a number of reasons. If the company just simply says, and they recognize this thing that we're acquiring, we could never have done that. We just never could have put the expertise together. It just didn't necessarily fit our culture for how we fund things or our risk profile or, maybe where we're located in the world or whatever it might be. We would never have tried to do that. That's sort of one approach. In many cases, what's happened is the acquiring company has tried to be in this marketplace. They've tried to build this technology. And at some point, they realize this is just too hard to do. This is just too expensive to do, or we're just not fast enough. We're never, by the time that we get this done and we figure it out and we build our learning curve and we build all the teams and everything in place, we're going to be 3 years behind the market, 5 years behind the market, right? And, so this is where, especially bigger companies do this, maybe not smaller companies because they just, they didn't have time or spare people. But I bring this up because it's really valuable to understand. If you try to do it yourself and then you acquire it, oftentimes what happened is you, as the acquirer, the one who tried to do but failed, oftentimes think, well, I really know this market. I really have an understanding of it. And I've seen so many times when they acquire a company in which they then sort of take their perception of what would make that market space successful or that technology successful, and they try and push it down onto the acquired company, right? And in some cases, having the perspective of being a large company and working with certain kinds of customers, is a perspective that you can bring that the acquired company doesn't understand. But oftentimes on the technology side, you probably, because you didn't get it right, you probably don't know what it takes to be successful in this space. It's an interesting thing. And the reason I bring this one up is because if that happens, you really got to take a look at who the leaders are of both the acquired companies and the acquiring companies to figure out, are they going to be able to kind of get past the who's the smartest in the room challenge, right? Because oftentimes when an acquisition happens, the leader of the acquired company is like, all right, they acquired us because we really know what we were doing, and therefore we should sort of set the tone for where things are going forward. And the acquiring company oftentimes sits there and they go, well, we bought you, we acquired you, we're higher up on the org chart than you are, so we should get to decide where things go forward. And so again, this is a very interesting area to watch out for, especially when it looks like, well, these guys are going to be a perfect fit together, right? This one has this and this one has this, and they don't overlap and so forth. But oftentimes that can become a pretty interesting area of, will this succeed or not? And again, it's not always the bigger company is going to make the mistakes. It's not always the smaller company is going to be better at this. It really is. It's a dynamic of the leaders of the two different companies, and or the group that acquired and the leader of the previous company. Because again, this is sort of build versus buy has so much baggage to it. It has so many assumptions about what works and doesn't work and why did it work. And that's probably the biggest thing as to whether or not acquisitions will be successful or not is getting through that type of thing. I'll give you another good example. I was part of an acquisition. I was part of acquiring a company, and one of the biggest hangups we had was not that the two groups differed on technology. They were both really excited to work with the other one. One had great market share. One had really innovative new technologies and so forth. But they lost the CEO of the acquired company, the smaller startup company, because he went in and on day one, he said, well, we're so important, like this technology is important to you guys and we're so important. I should be the CEO of the bigger company. And the amount of pushback that sort of got, for a company that was doing, $100 million to a company that was, doing almost $10 billion was sort of laughable. And then, but from that, that sort of perspective, it created some interesting tensions. And ultimately, that founder ended up leaving the company maybe earlier than was expected. But anyways, you see a lot of that. Next thing I had on my list, and this is sort of really important, but not always thought about, is people perceive that when an acquisition happens, that the parent company, so let's just say the parent company, the big company, just has they assume like, the CEO bought this company, right? Like they took their company funds, the leader of that company bought that company, but this is where the nuance is, and this is really important to watch as well, especially when you see a smaller company get bought up into a bigger company. Usually what happens is it's not like the CEO does the acquisition. It's a line of business within that company does the acquisition. They basically say, hey, we're willing to take on that additional capability. We're willing to figure out how to fund it out of our revenue stream and our profit and loss and so forth. And it's going to fall into our group, right? And this is where it's really interesting to ask, like when a company gets acquired, where are they going to go? Where are they going to end up in the org chart? Because oftentimes there can be a mismatch between the best place for an acquired company to go versus this is the group that acquired them. And I bring this up only because like there are lots of examples of companies, bigger companies who have a whole bunch of organizations. Maybe they all sell different products and so forth. And you need to not only sort of have the fit of, hey, we got acquired, but like the going forward plan needs to be aligned, right? So this is where you can have go to market that's not aligned between the two companies. You could have profit margins that aren't aligned between the two groups that sort of are now coming together. You could have just huge personality conflicts that maybe aren't aligned, maybe aren't visible when the acquisition happens. So it's always, it's kind of interesting to see that happen. And I've seen that happen many times where, one of the companies I was at acquired a company, but they ended up in a weird division that weirder than they thought. And there was, forever they were going, well, why can't we go over and work with that group? We're the most logical to work with that group, not the group that we ended up in. So something to sort of keep an eye on and watch as acquisitions are happening is like, is there good alignment between the acquired company and the actual group, not necessarily the parent company, but the actual group where they end up going. And that oftentimes can determine success or failure of an acquisition. Next thing I had on my list was how independent or integrated does this acquisition happen, right? In some cases, it makes total sense for the thing to be just sort of like immediately integrated. Like, the smaller company would benefit from the sales and marketing and go to market and training and partner channels and all those sort of things. Like, it's just a perfect fit. It would just work. It's already sort of been integrated. The technologies were already working together. In other cases, it's almost better that they are somewhat of an independent entity. And again, this often happens if the go-to-market approach, the cultures approach are very, very different. And I'll use Red Hat as an example. Right, one of the things that the Red Hat leadership, for example, told IBM when the acquisition was going to happen, or when it happened, was, because of the unique sort of nature of Red Hat and the way that they did things with open source and the way that their business was very, very partner centric, if you do the sort of traditional, what they call blue washing, and fully integrate us on day one, and our only path to market are really through the IBM path to market, you're probably not going to get the full benefit of what you would have expected from the acquisition, right? And so they're kind of a good example of a company that got to more or less remain independent. Now, well, still rolls up, financials roll up, and all those other sort of things, but still remains somewhat independent. while part of the bigger umbrella and so forth. So, that's an interesting thing to sort of watch because again, it there are ways to, if you have mismatch of culture, mismatch of go-to-market, you just have different structures for how the business was successful and so forth, or, how partnerships happen or other things. Depending on the level of integration you expect versus independence you allow, can be a big impact on success or failure. Next thing, and these are just sort of last two things I had on my list. The first one is, what's the learning curve for the new company, right? So, one of the things that oftentimes happens is acquisition happens. Let's say it gets through all the regulatory stuff. It doesn't get held up for months and months. And, the closing happens. What's the learning curve for the new company? Because, this is a really simple thing. For a lot of smaller companies, the people who work there are there either because they're fairly young and they're just like, hey, we just decided to start a company. We've never worked at a big company before. Or they are people who've worked at larger companies and said, hey, that feels like it's bogging me down. I don't feel like I'm able to reach my full potential. I'm excited about something else. The small moving into big dynamics are challenging. And the faster, and Cisco did an outstanding job of this, even though lots of their acquisitions failed. They realized after the first couple of acquisitions that they made that they needed a dedicated team to make sure that whoever they acquired could navigate the bigger company, right? And I see this happen so many times is the company that acquires and the acquiring company don't put enough resources into the, how do we internally make this successful? How do we make sure that people know how to communicate, that people understand org charts and sort of power dynamics between groups, that they understand the culture of the new place, right? How well do they adapt to change? How well do they deal with sort of failure and experimentation? What are the sort of taboos of the culture that you have to be aware of? Even the most simple things like, what's the expectation when you go engage with a customer? Like, what's the dynamic of that going to be? What's the dynamic of even simple things like, how are we going to present stuff, right? Do we use, what sort of presentation style do we use? How do we expect to dress in front of the customer? Who do we typically get in front of in terms of the level of the company that they work with? And understanding all those things, you may not necessarily have to agree with all of them, but understanding them is so much work just literally in the first year of an acquisition. Think of it just like anybody's job, right? The first year in any job is a lot of learning, a lot of learning curve, a lot of how does this work, a lot of asking people. And so the companies who do it well, have sort of a structure in place, and their goal is not to necessarily be like, well, I'm going to treat you like a new hire and I'm going to teach you everything about our company. It's going to be, let's understand how we both work and see if we can find a way to sort of get the best of both of what we do, right? The what we do from a scale perspective, what you do from a speed and agility perspective, how you like what does success look like when you're in front of customers? What does success look like when we're in front of customers? All those things oftentimes gets overlooked. They just sort of end up in a group. It's like, hey, we'll put you on the email alias and yeah, we'll invite you to the next all hands or whatever. Like, the companies that do it well, and if acquisitions are going to take off, those sort of structures and teams have to be in place. Last thing I've got on my list is, what's the plan for retaining key people, and what are the expectations of key people? And what I mean by that is not just, the CEO and CFO and so on and so forth, but like, key engineers, key salespeople, key marketing people, key, what the people that ultimately made the company successful. And I bring this up only because this can have impacts in multiple ways. In some cases, depending on how big the acquisition was, the size of the acquired company, you're going to have a lot of dynamics in play, right? For many startups, they've been at it for a long time, right? It's very rare that you see an acquisition happen after like 2 or 3 years because most companies still haven't really found product market fit. It's a little different in the AI space because there's a lot of just like, let's just bring back the Google brain team, get them all back together, whatever that might be. But oftentimes, you see these companies that have been startups for 5, 6, 7, 8, 9 years. And so, while the founder might be really excited about the acquisition happening because they've got something happened in which they're able to get a lot of their money back, but they may not continue to want to be motivated to run the business, right? So you're going to have a lot of different motivations of people who, do they want to stick around at the business? Do they want to continue to sort of live that lifestyle of the hours and the responsibility and so forth? How well does the acquiring company make it worth their while to stick around, right? Do they sort of golden handcuffs them? Do they make it so that, if you stick around for multiple years, the payoff is significantly higher? Oftentimes that's important to know, but it's also important to know, how well does the lines of communication continue to happen from the leadership of the acquired company down to their staff and so forth, or is it sort of coming from the acquirer company, right? And this is, again, one of those things where as you move into big companies, understanding where's the goals going to come from, where's the motivation going to come from, do they understand our culture very well? All those sort of dynamics are difficult in the first year, but they're really important to sort of watch, because again, it's you're trying to figure out, like, how do I get through that first year, first 6 months, whatever it might be, new expectations, high expectations, but secondarily, like, who's it coming from? Does it still come from the people that you've been in the trenches with, that you've understand how they deal with stress and pressure, or is it people that you just don't really know yet? You don't understand them. You don't know what motivates them. You don't understand why they're asking for certain things. And so that's a really kind of important thing to watch is, the more stability you can create in those first couple of years, the better. But oftentimes that's a difficult thing to do because the people who are being acquired either overlap in terms of jobs and responsibilities. Maybe it's a CFO, maybe it's a head of marketing, maybe it's a head of HR or whatever it might be. Or you people are just like, I don't know if I still want, if I still am as motivated as I was when we were the small company and we were kind of David versus Goliath. So anyways, I'm going to wrap it up there. I've been going for quite a while. Hopefully touched on some things that can be helpful in terms of, as acquisitions, if they do happen to start picking up, if you're part of an acquiring company or you are an acquired company, if you are trying to understand, we rely on one of those two companies, what's going to happen in the future, what are they telling us versus what are we seeing? Hopefully that gives you some sense of kind of how a lot of these things kind of shake out from, lots of different perspectives. So anyways, with that, I'll wrap it up. Hope everybody's doing well. Hope everybody's starting to enjoy springtime. We are excited about the sunlight being out and all those sort of things. But a lot of really good shows coming up. Really excited about some of the things that Aaron's been doing with some of the guests that we've been talking to lately. So with that, I'll wrap it up. We'll talk to you next week.
Thank you for listening to The Cloudcast. Please visit thecloudcast.net to find more shows, show notes, videos, and everything social media.